On the sidelines of the JP Morgan India Investors Summit, we are in conversation with a man who needs no introduction now. A lot of viewers in India now know him for his wisdom around where India stands on the pecking order of global markets. Rajiv Batra joins us right here. Rajiv, great having you. Thanks for joining in and thanks for having us in your conference.
Thank you. Thanks for having me.
So what's the response been like? I know the response has been fabulous ahead of the conference because 30% more participation, etc. Yeah. But you've spent about, 36 hours here in the conference. What are people asking you the most about and what's your response been to that?
I think the foreign investors who have visited, and especially the one who are visiting for first time, are really shocked to see what's happening in India. Like, they didn't anticipate that even if the stocks are trading at around 50 PE, 70 PE, there is still a mad rush chasing that name over there. Because if you go outside of India, if you're trading at 15, 16 PE, so, oh my God, that's expensive, I shouldn't touch. But here, if it is 50, 60, people think, oh, it's a value. Don't you buy on this one? And this is largely because the first-time investors who are coming from territories like China, Malaysia, or even I will say some part of the Middle East, all these markets are trading at a multiple of around 8 to 5 P kind of a zone, 15 P kind of a zone. So when you reach to a country where large cap is 24, mid cap is 50, I don't even want to talk about SME cap, which trade at some berserk valuation. So taking all these factors into account, there is a surprise. But interestingly, I remember last time when I was there on your show, we highlighted that JP Morgan expect $100 billion inflow in Indian equity market. Money has started coming in. Last 7 months, India has witnessed $11 billion inflow. And these people, foreign investors who disagree with that thesis, are now not questioning valuations and investing in Indian equity market.
Hey, that's great to know. So two questions from your first answer. I heard you say that first-time investors coming out here, there is a larger participation. Are these first-time investors completely alien to investing in India? And therefore, I'm guessing because they are JP Morgan clients, they are big checks. Are those big checks waiting to come in even at these valuations?
No, so definitely for them, even if you offer a stock or a sector which gives them only 9% earning growth, my domestic investor may not like that particular sector and stock, but you ask somebody outside whose country is delivering 0 or a -% earning growth, from them 8 to 9% kind of a growth with $50–60 billion market cap, for them it's an wow moment. Like, let me invest and forget in this market. Hence, this is the reason why they are willing to revisit. So where my domestics are chasing alpha generation in mid and small cap, for foreign investors who are looking alpha in diversified external market, the large cap in India, which is giving them 9 earning growth, 15 ROE, 60 billion market cap, let's invest into that name.
Wow, and there is there is a reasonably high likelihood that the currency will also be a lot more well-behaved. Some depreciation would be welcome in Sajid Chenoy's words.
Yeah.
But it's not like India is now part of those fragile economies wherein the currency could depreciate 8, 9, 10%, and therefore it could, on any given day, and therefore there could be a loss to the global investor as well, I reckon.
No, for the foreign investor, they're saying that it's a matter of time when we will start seeing the appreciation in Indian rupee. Because the way which Indian rupee has reacted, dollar gone higher, rupee maintain 80 zone, dollar gone lower, rupee maintain 80 zone. So they know the strength on the balance sheet side, fiscal, as well as on the current account side, which is not showing up in the currency. So the trade they are playing in India is not just the equity trade. It's the dollarized equity trade that 1 in 5 or 10 years time, the moment comes when currency start appreciating, that will be the windfall gain for my foreign investor. So that should be taken as a positive point.
Got it. Wow. Rajiv, so tell us this then. There is large cap space. My view somehow of the last 12 to 18 months, that India seems to have become a low beta market. Relative to what it was, maybe relative to some of the other markets as well. You're talking about the possibility of at least currency stabilization at the bare minimum, maybe appreciation, large caps offering value. Would you reckon that this gap between 100 billion of expected inflows, which turns India into an equal weight from an underweight, versus 10 billion or 11 billion that has come thus far, you reckon this gap of $90 billion, which is a lot of money, could get filled over the course of the next 12 to 18 months?
I'll say 12 months will be a stretch, but definitely 18 to 24 months is well enough. But I will say it's contingent upon capital issuances, that is the fresh money, primary issuances coming or additional offers. So we have seen over the 12 months, $50 billion issuance have happened, primary and the secondary side. Foreign investors have largely come into them. One, because they don't have to chase liquidity at a higher valuation. So that's an easy way to get out over there. That's the point number one. Point number two, it's most probably give them a bit kind of a favorable opportunity to enter into that space. As an example, if you are competing out in the secondary market with the domestic, with HNI, with PMS, with AIF, it becomes too crowded in this one. Here you get simply a position out. So that is the key reason why, like if you keep on having new primary issuances and secondary issuances coming up, that will give easy way route out for foreign investor to come. And remember, it's not just the active guy, the pressure is also there on the passive guy too, because India is slowly and steadily inching towards the mark of either meeting China or beating China in terms of an index weighted. In MSCI IMI index, which tracks $125 billion passive allocation, India has already surpassed China. But the bigger index, which have a $500 billion passive allocation or chasing, that's where we are still 1.5% lower than China. But as the weight keeps on increasing, you will not only get money from the active investor, you will also get the money from the passive investor also. I have given you the sizes, just multiply the weightage and apply how much money it will be.
Wow, crazy. Just it's mind-boggling numbers, I'm sure. But it's not a 0 and 1 moment, right? As the weightage keeps on increasing, the money will keep on flowing in. If India were to eclipse China as the highest weightage in the MSCI EM market, IMI has happened, but the other one that you mentioned,
benchmark.
But it's not a 0 and 1 moment, right? As the weight keeps on increasing, money will keep on flowing in, right? I presume.
Yes.
Okay, great. So in about 18 to 24 months, significant inflows from foreign investors 100%. Anticipated.
Yeah.
You mentioned a very important point, and that's true. I mean, we've seen fair degree of foreign participation in the primary markets. Yeah. There are, and there has been a series of blocks, PE investor exits as well that have happened. You see foreign investors trying to now ask you actively for that end of the market to primary is one thing, and I'm coming to that. But in the listed space, whether QIPs are happening or Ps are exiting or promoters are shedding some of their own holdings for whatever reason, are foreign investors wanting to lap those up as well?
100%. So the most interesting conversations I'm having with my investors over the last couple of weeks, they're saying the biggest foolish thing any investor would have done was not to chase this IPOs or the QIPs or blocks in India market, because it's kind of a no-brainer strategy. Whenever any kind of an IPO block or a QIP is coming, you subscribe to it. And if you look at a performance 6 month, 3 month and 12 month forward basis, your performance ranges from 30 odd % to 150 odd %. Hence, it has been one such momentum strategy, like you need to keep on subscribing. Now, seeing that as a successful strategy year to date, if it continue for the next 12 months or even an 18 month also, I think the other set of foreign investors will keep on joining the bandwagon.
What about the primary markets? Because you mentioned that we need high quality paper to come in. There is Hyundai IPO, there is a Swiggy IPO. At some point of time in the next 12 months, we'll probably see NSC and a clutch of others coming out too. Are you personally excited about the primary paper?
No, as I said, we need it. If we don't get one, then your journey towards a 40p for large cap will be very soon, which will be a bubble territory for the market. So if anyone asks me today at 24p is India is expensive, my answer is absolutely no. Because in case of an Asia, since 1989, any kind of an Asian economies who have went to a bubble territory, be it China, Japan, Taiwan, Thailand, Korea, all were marked at around 35 to 40 PE. India is still at 23, 24p kind of a mark. So if you don't come with the primary issuances and everyone is chasing the same set of a secondary markets only, your 40p will come very, very soon. So that's the reason why to keep a balance. And we have a SEBI panel yesterday, they were presenting and they said even they are looking that the demand supply mismatch should not be that huge enough that can create a kind of a high valuations in the secondary market. So that's the reason why this primary paper is must and a proper hygiene factor for market.
I'm loving what you're saying. You are not saying if or whether the 40p will come. You are saying 40p to aana hi hai. Whether it comes sooner or later is the question.
Yeah, it's on the market dynamics. Wow. Because here you are not having just one investor foreign. Remember, you are dealing with 3 set of investors. Foreign institutions, domestic institution, and then retail, which includes PMS and AIF. So that's the competition it's having. The only 4th player who is giving up is your promoters. Like from a 70% holding, they have come down to 58%.
But that's not outlandish, right? A lot of people raise eyebrows. US has been through that journey wherein promoters gave up their holding. Is that something that you question, or you believe that's just part and nature of a market development
I think
process?
if we talk about the Vikasit Bharat, then in a developed market, the free float is quite high. The liquidity is never an issue. In US, the retail holdings of the market, direct and indirect, is 48%. In case of an India, if you look at a retail holding overall, which includes some PMS and AIF too, it's only 8 to 9% of the market. And if you look at the household balance sheets on how much allocation they have allocated, 6% only, because most of the other are in gold, physical assets, and the term deposits in this one. So right now, the limit from here to go higher is multiple times. So that's the reason why I'm saying, like, valuation, no problem for me. Promoter or a PE selling should not be a problem for me, because you need a very diverse market where everyone has a share, rather than an illiquid market where only one set of an investor is purely owning the market. And that's why our beta is lower, and we are seeing the you can say resilience in market.
Yeah, sorry, I'm trying to wrap my head around this. I'm reconfirming things, Rajiv. You are saying that everybody is raising question marks around the valuations of the Indian markets. Sure, in the SMID space there may be, but you are saying that we are headed higher both on the absolute levels as well as on the multiples as well.
Yes.
Okay.
Yes, and other way to look around, Neeraj, would be look at market caps to GDP ratio. The peak market cap to GDP for India was 150% in 2007, the last cycle which we have seen. Even today, despite all this rally, we are still at around 120, 125%, where denominator GDP is still going a rapid pace over there. And now if you compare with a similar outperforming market like us, Taiwan and US, Taiwan is 300% and US is 225.
Got it. Okay. What excites you about India the most? Because there is a lot of stories being out there in the market, a lot of stories getting developed, which might become really big in times to come. From your vantage point, what is it within India, bottom up, sectoral, excites you the most currently?
In terms of a key thing which India excites me about is demographic and urge for people to innovate. It's like, even if we talk about the literacy, not just on a basic schooling side, but even a tech, financial literacy, India has quickly become adaptable to changes and innovation at quite a faster pace. We suddenly saw here, like, people are talking significantly about investment into the EMSs, to semicon, fab, investment. So that shows even the entrepreneurs, promoters, first or in a second generations are willing to deploy and willing to give all of it to innovate and take the cycle forward. So rather than being stubborn and saying we will grow on this criteria only, India is being quite flexible enough. And that adaptability has become now a key for India. So that's the reason why, if any changes are happening globally, be it on the nuclear side or even on semicon side or even space side, which Prime Minister Narendra Modi is doing really good work on, or even on EV side or green energy side, India is looking into the forefront. Even if we are not there in top 2 or top 3, we will make sure India is either in top 5 or in a top 10. So that has become a key. So we can definitely choose the sectors and themes that are coming up. But according to me, the key is the way people are flexible, adaptable, and innovating at a constant pace. Now within that, you can say themes that are emerging. It's like power, your infrastructure, EMSs, even now on still on the EV side. So themes are multiple, but the key for me is that innovation and adaptability.
Okay, I'll come to the innovation piece, but I'm just trying to understand the themes that you mentioned within that, right? All of them, the bearish argument out there is that the valuations of some of those are extremely expensive, be it EMS, be it power, and maybe not power financing, but almost everything is related to power has become very expensive. how are you constructive at these valuations on these?
Maybe I'll counter question you on this one. Like you go decade or 2 decades back, you pick up the FMCG companies, you pick up the top-notch private banks, you pick up any kind of healthcare companies. Either they were trading in the price to earnings ratio of 40 to 50, a decade or 2 decades back, or the price to book of a financial 4x, 5x price to book over there. But still, the stocks keeps on rallying, and analysts keeps on defending their price target and keep on raising higher. Where is the key? The key is in the DCF model. What kind of a terminal growth rate you are implying? So if you are implying a terminal growth rate of looking back of 10 years and 20 years where things were slow and cycle was not at that you apply 7%, 8%. Now suddenly, because your nominal GDP growth is rising, government is putting more focus toward that, and that wants a terminal growth to be double digit or even a high teens. If you apply that number on your DCF model, for 10 years, 15 or 20 years, valuation will not be expensive. So rather than doing that, now to justify every couple of years or 3 years that, okay, my 70 P stocks will still give me a 20% upside next year, what the analyst will do, he will keep on increasing terminal growth rate by 1%. Rather than doing that exercise, take a structural call, see where the country is heading in 10, 15 and 20 year direction, raise your terminal growth once for all, and also reduce your risk premia. Because with India entering into the GBI EM index, which calls for decline in the bond yields over there, decline in the risk premium as we talked about the lower beta, that is another factor which will support the market. And most importantly, we kept on questioning on earnings risk premium for India over there. Look at the 2 decade performance. US have given us 4.5, 5x return. India has given 6x return. The only market who have a tenacity to either perform in line or beat US in US dollar term is only India and EM.
Well, an India bull would love listening to you, Rajiv. I must tell you some very compelling arguments. The other question is, and then I'll come to the innovation part and finally end with what are the risks facing. The other question is a lot of the themes that you mentioned. EMS may not have as much of a supporting infrastructure listed, but power. Power generation is one, but the whole power equipment, T&D, etc. is a mid-cap, small-cap sector. It is not large-cap. The growth rates seem promising, but the valuations are expensive there for sure. So if you're playing power, let's say, and you're talking about the terminal growth being higher, etc., is it true for the whole ancillary pocket as well, or is it only true for the top-tier companies wherein the liquidity is also very high?
No, this will be the much more an average one, but depending on the chain, on the value additions which you are, and in terms of a competition in the pricing power, the things will differ. As an example, right now the transformers guys or the grid guys, they are charging you higher valuation in this one because supply is a constraint, not too much competition is there, pricing power is there. So by default, they will enjoy a certain higher pace of a growth. Place which are crowded enough and where you have intense competition, pricing power is also lower, there you will not be able to generate a much higher growth premium. You will be generate on an average kind of. So that's where within the chain we will need to differ just based on the two components, pricing and competition. And remember, competition should not be just the competition right now. As we talked about innovation, remember, as the demand rises, we see more of the startups start joining the bandwagon. More of the PE and VC start deploying on the particular sector so that they enjoy the demand which is coming through. So similarly in the power ancillary space also, maybe a 5-year or 10-year down the line, as the startups or the PE who are investing and the new capacities start coming, they may start seeing the reduction in risk premium also. And that's where your growth will also come set a bit lower. So it's important which part of the chain you are looking and then looking at these two dynamics.
Got it. Sanjay was telling me that JP Morgan as a house seems very constructive on real estate as well. Yeah. Are you personally still constructive on real estate?
Definitely. I think for crux of any equity market, capital market, real estate is a key. And if real estate sector is dysfunctional, you will see neither growth nor there is a vibrancy in the capital market. We have seen what China has been going through post what happened in the property market segment side. So that is the key reason why we are seeing with the income power, urbanization, rising trend, and now hopefully we are seeing some inflection around the rural consumption and the rural growth also. So that will be further supportive for the real estate sector overall.
Okay. Last two questions. One is just a bit of an elaboration on this whole innovation piece that you spoke. Now, in some sense, there are hubs which are becoming startup centrals, right? I mean, you have a cafe you walk into, you have a bunch of people out there trying to build a startup, and it's not just one table, multiple tables out there. So there is innovation happening at a frantic pace in India. What has impressed you the most from an investor lens? Within that whole gamut of newer themes that are coming out and newer innovative business models that are coming out, what has impressed you the most?
No, what impressed me the most is on the way we are functioning on the AI side. I know there are still a constraint because India is a lot more dependent on the imports of hardware, components and everyone, but that's not stopping them to take a step forward over there and evolve and try to rub shoulders with the global giants out in the US, Europe, Japan, Korea and Taiwan. And I've seen that happening because I'm based in Singapore, what the companies in Malaysia and Vietnam have done. So seeing their cycle of last 5 to 6 years, how they evolved and then they partnered with multiple companies in the US as well as China and Japan. I think even India is also moving towards the same direction, looking at the cycle. But considering the size, scale, pace and the policies, yesterday we had Union Minister Ashwini Vaishnaw joined us and he highlighted government plan. It was really exciting to see about how much government is trying to invest into that space and try to promote overall that sector. So with the talent being in place, clean energy, which is the key overall to supply over there, top of it policies. So you have a positive trifecta going for this entire space to pick up. Now you name it under AI, EVs, or you want to name it under any other sector with the space at the other one which is coming up, or even in the defense right now. I think all the spaces it is going through, because in India there is multiple opportunities right now are available, and that's the reason why when any young graduate, as you mentioned out, working out of cafe, being an engineer over there, he's not just thinking about a job, the 9 to 8 hours job. He's thinking even about back of the mind how I can contribute as an entrepreneur, how I can innovate and provide something new to the country. So that is the change which I have seen happen over the last 10 to 15 years in India.
Got it. Risks to this very promising outlook that you've portrayed for
in
us.
Emerging markets, remember, always the first risk is policy and politics. You need both on the right side, which thankfully, with all stars aligned, it's there with India for almost close to 2 decades. If this mix goes wrong, we have seen emerging market from a structural story of growth becoming a structural derating story also. So that's where the number one we have to take care of. Near term, yes, there will be some hiccups around if oil prices start rising because of a geopolitical tension. Because right now, nobody in the world is taking geopolitical risk premium very high. So anytime if it's evoked, there will be some set of a kind of a correction. Oil prices, yeah, that's nobody can guess which direction it will move. It is also linked to geopolitics as well as demand, which is slowing because China growth is at a 3 handle. US is also on the soft landing side. So oil prices is also not a concern for you. And last but not the least, unemployment. So remember, the other problem beyond policy and politics is unemployment. India have been blessed where our unemployment is in a single digit kind of a mark rather than neighbors who have a high teens unemployment number. So if unemployment is not there, you don't need to focus on consumption. You can still keep on growing through investment, capex and overall investment in the system.
Great. Rajiv, lovely talking to you today. Thanks so much for taking the time out. And look forward to talk to you once more, maybe before the end of the year, but have a lovely remainder of the conference.
Thank you. Thank you.
And viewers, thanks for tuning into this broadcast.